Welcome to Retirement Designed Differently with Billy Voyles, financial advisor and the founder of Fundamental Wealth Designs. I'm your host, Spike Spengel, and every single week, Billy likes to help you with retirement planning solutions. Mr. Billy Voyles, what's on your mind this week?
The market, of course. Now, I'm a financial advisor, so the market is always on my mind, but we're going to talk today a little bit more about the risks associated with the market and the various investments you out there might be invested in.
That's one of the things that usually gets the phone ringing when we talk about the different risks, what's going on, and then your perspective about what we're supposed to do about it. Now, here's the thing, Billy. We haven't had a lot of market volatility, I'd say, I don't know, in the last 2 years. But we can go back to some very recent events, everything from COVID in 2020. You go back to the events of 2008 and 9, huge dips, took a long time. You go back to the dot-com bubble of the 2000s. There's a generation that's getting ready to retire that has seen a lot of market volatility, and maybe they took too much risk off the table. When folks are coming into your office, how does it look with what their risk structure looks like?
Yeah, and that's one of the things we run into, because when you're trying to time the market, getting out of the market's easy, but getting back in is what's difficult. And there's no sort of, there's no one waving a green flag that's telling you now's the time to get back in the market. So COVID's a perfect example. When the markets were dropping like crazy right at the introduction of COVID, a lot of people got out of the market and they sat there in cash.
Yeah.
But there was nothing.
There's no indicator. There's no green light. There's no announcement out there saying, hey, folks, get back into the market now.
Yeah, so all of a sudden the market recovers and they miss out on the recovery. And now they're behind the 8 ball because now you're stuck in cash. You're not making any money. The markets have already done their run up. So timing the market is very difficult, and we try to discourage our clients from timing the market.
It's a huge, great, wonderful conversation. There's so many different avenues we could take this down. One of the things I see, and you can look this up on your own, folks, you go on that great search engine that is never incorrect, the interwebs. Go out there, go ahead and look it up on your own. But folks don't tend to get the returns that a fund itself gets.
Yeah.
Now, the fund will do reporting periods, 6 months or daily, and then the 1 year, the 3 year, the 5 year, the 10 year. And folks look at a fund and go, I want to receive the returns that thing gets. But why is it that the retail investor doesn't actually make what the fund itself makes?
Yeah, and Spike, you're referring to the behavior gap. So Carl Richards actually is out there writing, and he's a great artist with a Sharpie is how he likes to talk about it, but he coined the term behavior gap. And it's the difference between the investment return and the investor return. And it's been shown that studies show that could be a 2 or 3% difference between what the actual investment gives over time versus the investor, because they're getting scared and they bail out. They're getting greedy and they buy at the wrong time. They're actually violating one of the principles, which is buy low, sell high. Mm-hmm. And in following this pattern, sometimes they repeat it till they go broke, which becomes...
Right, and usually that desire to act happens when that market has gone down, but even if it's a few percentage points, you go, oh, I better get out now, and then you sell, and then you see the rally coming back up. So even though the fund makes, let's just say, a number 5% over a certain period of time, the retail investor's lucky if they make 2.5%. Let's also throw in there the fees and what platform they got that from.
Absolutely, and not everyone's like that. Some of you are out there and you can stomach the risk. We have a slide in our presentation that we do at live events which goes through sort of different types of assets in retirement. How much volatility do those particular assets provide back to the portfolio? So one of the things on that chart is an individual stock. If you own an individual stock, it's likely to go up and down faster, quicker than the broader market because you have company risks associated with that. If you tie your performance to an index of sort, now you have a broader market exposure. It's not going to quite move as fast around as that individual stock. And then you have a truly diversified portfolio, which we often create for clients, which is even steadier than that sort of stock market index. So there's a lot of different things we can do in order to limit volatility. If you don't like to stomach those ups and downs, and especially as you're approaching retirement, your risk tolerance changes. And our portfolios are designed specifically to match your risk tolerance. They're not a cookie cutter portfolio where everyone gets the same thing. We design portfolios specifically for you.
Billy, I think this is why people tune into the program, so I'm going to throw this one right at you. Just tell me, what are the markets going to do for the rest of the year?
And if we knew that, Spike, if we knew that, we would put you in the right investments. But we don't know what's going to happen in the market. And some of our prospects, I would say, they want us to sort of tell them, what's my rate of return going to be? I can't tell you what your rate of return is going to be, but what I can do for you is prepare and plan rather than predict the future, right? A lot of people have tried to predict the future and been wrong in the past. That's not what we want to do, especially for your retirement. We only get one shot at your retirement. Do you really want someone, gambling on your retirement? That's not what we want to do. We want to create a plan that sort of is sustainable through anything the market throws at us. We are prepared to sort of tackle those when they come. Yeah,
the risk tolerance and kind of a bandwidth, the markets are going to go up and down, but then there's other features like rebalancing the account, keeping it in the risk allocation that you're most comfortable with, getting a little bit in returns. But I'm going to ask you about your mom when we get back.
Oh, yes, let's bring it back.
She's one of your favorite investors, isn't she?
Yes, so for everyone, we do a risk tolerance questionnaire, and we try to figure out, how much risk do you want to take inside your portfolio? And what it spits out at the end of this questionnaire is a range from 0, which is the least amount of risk possible, to 100, which is the most risky we could possibly put you in. And the record, my mom holds the record for the least amount of risk, the most risk-averse person in the market. And, I think she got there because she was a nurse and maybe there was other risks associated with her work, but like with her assets, she worked so hard for them that she couldn't stand the thought of losing them. And I think that's really what drives her avoidance of risk, is having worked 40 years to sort of amass this sum of money, she's truly terrified to lose it. So she wants solutions that are going to fit her risk tolerance.
And I don't think your mom is alone, though. I think a lot of folks who walk through your threshold, maybe not quite as risk adverse, but say the same thing. I don't want to lose what I've saved, but I need to make sure it's there for me. So that's why we talk about your retirement design. And that's exactly what Billy and his team can do for you. It's going to be tailored for you, your risk tolerance, your age, your goals, your objectives, and what does your spending plan look like? What do you want that retirement to look like? To get your own retirement design, all you have to do is call the phone number down on the bottom of the screen. This isn't a book or a pamphlet or something that we just mail out. You'll come into the office. Billy will sit down with you and we'll just have a discussion. What do you want that retirement to look like? And we'll start designing that for you. And for our television viewers, there is no cost to that. There is no obligation. There is no inflation risk to the cost of our retirement design. We put that together for you. Call the phone number you see right down here on the bottom of the screen. More with Billy Voyles, founder of Fundamental Wealth Designs and a financial advisor himself, right after this.
Changing from now being an entrepreneur and running our own business and working with clients, it's challenging, but that's what makes it fun, right? If you woke up and did the same exact thing every day, made a widget, and then the next day you make another widget, and the next day you make another widget, this really, every day is a new day. And every client, all their plans are going to be different. They're going to be designed specifically for them, because you can't create a cookie cutter plan today that's going to fit everybody. That's not how it works. In order for it to be the best, it has to be tailored specifically to them. Meeting with people is fantastic. We love doing events. We do events all over the Twin Cities. I love speaking in front of people and educating, providing people education for their retirements. I enjoy putting the plans together and knowing that it'll set them on the right path that they need to be on for retirement.
Welcome back. Here with financial advisor Billy Voyles, the founder of Fundamental Wealth Designs. I'm your host, Spike Spengel. We're talking again this week about some of the risks of retirement, market volatility, how exactly Billy puts together the designs of your investment strategy, of course, all of the retirement, everything from tax planning, estate planning, Medicare, how and when to take your Social Security. We'll get into that a little bit more. But the risk tolerance, is that, we hear those questions all of the time. What is your risk tolerance? But I don't know if I'm the one properly able to define what that is for me. I mean, I say, I don't want to lose any of my money, as your mom says, or, well, I'd like to see gains. Is the consumer the right person to define their risk tolerance?
And that's one of the things that we work with is there's two types of risks, associated with market volatility that we need to consider when it comes to your plan. The first is risk tolerance. And the first risk tolerance is looking at how much can you stomach, Spike? How much risk can you stomach? Are you okay with it? Or does it just drive you crazy and stress you out and cost you sleep? If you're taking enough risk that it's costing you sleep at night, we need to change the portfolio. But the other one that is what we look at is risk capacity. So that is how much risk can your plan actually afford to take, but also stay sustainable for your income for the rest of your life. And sometimes we find that you might be able to stomach the ups and downs of the market, but it puts you in a situation where if the market goes sideways or down to a point where you'll run out of money. So I don't care if you can stomach the risk if it's going to break your plan. We're going to need to adjust that risk so the plan works as well. So that's one of the things we look at.
Okay, and making sure we don't get you in trouble during the holiday season or around your birthday. Let's talk about your mom again. She doesn't like taking the risk. But there's another thing that we need to talk about here. It's the when you're taking money out of those accounts. We're talking today about market volatility in our retirement accounts, but I can't control that. You can't control that. No one can control when the markets go up or down. We're in a time period right now where the markets have been up. And this is an okay time, I guess, to be taking money of our accounts. But what happens when the markets go down? What happens when those accounts go down? It's almost like a double loss.
Absolutely, and markets are at an all-time high. So right now, if you're taking money out of your marketable securities, you are selling high, which is a good thing. But the problem is I, nor any advisor down the street, can tell you where the markets are going to be in 1 year's time. And it introduces a concept that we talk about, that we will explain, called sequence of returns risks. And what sequence of returns means is the order to which the stock market returns or your investment returns come back to you during your retirement. What are those returns in the early years, in the middle years, and in the later years? And where it becomes sort of extra complicated is if you have negative years in your early years in retirement and you don't have a strategy, that is where it provides a significant risk to retirement.
Okay, though, but I'm going to go back to I have no control of when the markets go down. So do you try to look at retirement planning? You call all of your clients and go, all right, this is the year. The markets are up. We know that we can take money out. Because we can't control that. There are those simulations. You can find those things online. If you take the same $500,000, and on this portfolio over here, there's 3 years in a row of loss. And in this one, there's 3 years in a row of gain. This one eventually runs out of money before 25 years. This one actually grows if they just flip the returns. But we don't know when those things are going to happen. So when your mom comes in and says, I don't want to take any risk, how do we make sure the portfolio grows while not completely being out of the markets?
Absolutely. So we just have different tools in our tool belt. One of the things we have, they're called structured instruments, right? Where you can actually structure the amount of downside you'd like to take, whether that's 0 or 5 or 10 or whatever it may be. It provides us a floor to your investment. So that's just one of the tools. Again, has to fit your specific situation. We don't want to provide specific advice, but again, having different tools at our resources and not just generic mutual funds that we will throw you in, but providing purpose behind the plan and purpose behind the asset is one of the things we talk about. It was funny, I had a client actually propose to me, I'll have 30 years in retirement, so why are we talking about, not the long haul and sticking with it for the long haul? While you're saving for retirement, it's all about stay invested, stay in the market. Time in the market beats timing the market. And all of that's true. But I explained to her the concept that in retirement, you're going to need income. So you're going to be forced to take withdrawals out of those retirements account, whether you like it or not, because you don't have your paycheck coming in before. And that is the ultimate sort of shift in retirement, is that, yes, you might still have 30 years. You might still have to stick with it for the long haul. And that's why we sort of dedicate assets to income, dedicate assets to growth. That way you can let the money grow that is intended to grow, but you're spending this money that you're intending to spend. And we do this through various tools that are out
different
there.
kinds of tools that aren't just the investment account itself. We'll go ahead and say it. There are tools like annuities. There are tools that are insurance products. They have those rates of growth in there, but those have their limitations too. And I think it's just to have this conversation. There truly is no one perfect investment, right? Because you either get safety, growth, or liquidity, right? And there's three things. And in the Venn diagram of that, you never get all three.
Yeah.
You either have to have, can you explain that?
Absolutely. You have to pick two of the three. So let's go through that. So safety, growth, and liquidity, which is sort of access to cash. Can you withdraw it and spend it the next day? So a bank CD will give you safety and will give you some liquidity, but growth, it's better lately, but typically over time, they're not giving you a lot of growth. A stock will give you growth and it will give you liquidity, but now it doesn't give you any safety. So sometimes I will draw those on the board and I'll say, what's your order? 1, 2, 3. What's most important to you? Liquidity? Okay, there's certain instruments for that. Growth? Okay, there's certain instruments for that. Because there's really three worlds of investing. There's the stock market world or Wall Street world. There's the bank world, where your CDs and cash and checking and savings are at. And then there's the insurance world, where we do have annuities and life insurance and long-term care and all these other tools that have guarantees associated with them. And if you want something that's guaranteed in retirement, that's the bucket we have to live in order to provide you guaranteed income for the rest of your life.
And I totally understand. I came from a school of thought a long time ago when I started that annuities were a bad thing. There's a lot of emotions behind the word annuity. But if we were to change that word and said, how would you like to set up your own private pension? Well, yeah, I'd like to have my own pension. Yeah. Money that you can't run out of, money that you can't outlive. It's managed by someone else. But here's my question for you. So you designed those three different buckets there. The banking world, the investment world, you can maybe even say the real estate world over here is another one, and then this insurance world. You're not choosing only one or two of the, you actually put together a plan that might combine all of these.
Absolutely, and that's part of our holistic approach. So we have access to all the tools. We are independent, we are a fiduciary. Independence means we can go out there and pick any financial product that's right for you from any distributor. A fiduciary means we have to do what's in your best interest first. So if that means recommending an annuity, or if that means recommending a dividend portfolio, or if that means recommending one of those structured investments, that's what we're going to do. And we're going to provide you and educate you so then you can pick the right retirement that's right for you. So what we're offering today is to come in for a complimentary consultation that's going to lead to your retirement design for you. Give us a call at 888-379-1846. On the other end of the line are operators with access to my calendar, and you can sit down with me to go through your retirement designing process. We'll sit down in our first appointment, which is that foundation appointment, where we just get to know you, get to know more about you and your particular situation, have a cup of coffee while we're in there. Then we're going to talk about your goals in retirement, because we do create a goals-based retirement solution, and that includes, people love it, the spending plan. Let's give you permission to spend that money in retirement. Then we'll take care of your taxes, then we'll take care of your investments and make sure the rest of it's sort of set up for your family. So.
Right. Folks, call the phone number down there on the bottom of the screen. We can get you started on your own retirement design. There is no cost to get started. There is no obligation. As Billy said, you'll come in, maybe have a cup of coffee, water, and we'll just get to know each other, try to find out exactly what you would like to accomplish, what you'd like your retirement to look like. There's no cost to it, but you do need to act. Folks are standing by right now. Call the phone number, or if you want, as I know most of you are watching TV, you've got your phone there as well. Open it up to the camera function. Point it at the QR code right over here, and then click on it. It'll take you over to the website. You can schedule your own appointment right there, no cost. So either call, go to the website. More with Billy Voyles right after this.
Good morning, Ben.
Good morning, Ben. Birthday party for Carol in 5. Happy birthday to you.
Good morning, Ben. Happy Monday.
Daryl's birthday, be there every square. Happy birthday to you. As you can see from our quarterly report on slide number 62, we're trending in the right direction. All signs point to a very positive outlook for the next several years. If you peel back the onion
Ben, do you have anything to add?
The work never seems to end until the day it finally does. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
You're here with Billy Voyles, financial advisor and the founder of Fundamental Wealth Designs. I'm your host, Spike Spengel, and this is your retirement designed differently. Every single week, this tends to be our favorite segment. You might need a financial advisor if. So what is it for you this week, Billy?
Yes, of course, we're playing off the wonderful, you might be a redneck if, but you might need a financial advisor if you don't have a margin of safety set up already. So what are we talking about when we talk about margin of safety? Where did this come from? Who created it? So a lot of you have heard of this gentleman's mentor. His name is Warren Buffett. Very famous investor who's taken advantage of the market for the past 80 plus years. His mentor actually goes by the name Benjamin Graham. And Benjamin Graham coined the term margin of safety in talking about having something set aside where if you need emergencies or you need cash, you need income, you need something to spend, that you have that set aside so you can allow the investments to work for you. Warren Buffett's a value investor. He's a buy and hold investor. So if that's the strategy, you need something over here set aside that allows you to spend that money while the markets are going through their fluctuations, because markets just have their cycles. So that's one of the things, and we talk about it in a way, but there are different tools for that. So the tools for that might be an annuity, might be accessing your pension, it might be dividends. There's various ways we can attack it, but the concept is what we focus on.
It's incredibly important, I think, because a lot of retirees will head to retirement. They'll take a look at maybe what their Social Security is right now. Maybe they'll design a couple of things on an Excel spreadsheet saying, oh, I can probably take this amount. But there's so many blind spots in that. Taxes, inflation, the market volatility and sequence of returns.
Yeah.
You've got to be able to put in all of those factors and move those around. So when you put in those factors and you put this into your computer program, you don't want something that says 68% probability of success, right?
Yeah.
You don't want that getting on an airplane. We know that for sure. We don't want a 68% success rate shown on the day we're getting married, right?
Yeah.
We want 100%.
Yeah.
So how do you put in those factors? And do you kind of show people how you cook that all together and explain that to the clients?
Yeah, one of the things we can do is analyze your probability of success in retirement with the current portfolio as it stands. And what we'll find is if you're in a traditional 60-40 portfolio where you want to take 4 or 5% withdrawal rate, it does work 70 or 80% of the time. But the problem is that leaves 20 to 30% of the time where it does not work. And you only have one shot at retirement, so you can't have a plan put together that's going to fail 30% of the time. If that's the case, and even if we build a plan for that, now I'm going to tell you got to work longer. So would you rather work longer or change your plan?
Right. And in talking about market volatility today, we're not saying, of course, get all of your money out of the markets. There's two sides to the volatility. There's two sides to the risk of it. There's, of course, taking too much risk, taking your money out, and the markets are going up and down. But there's also taking too little risk. Do you mind talking about that? I mean, because you can run out of money the same way.
Absolutely. I mean, inflation, we talked about it. We talk about inflation a lot because the cost of living, the cost of goods are going up year after year. And if you're not taking enough risk in retirement, which is an odd thing to sort of consider, then you may run out of money because you didn't take enough risk. So that's one of the things. We run into that less often than we run into the people taking too much risk in retirement. But either way, it needs to be addressed. And one of the ways we address it is by giving you again, these buckets of money. We're going to design a bucket for income. We're going to design a bucket for growth. If we've already taken care of your emergencies and your income, all of a sudden now we find that our risk tolerance goes up. So we don't mind some of the ups and downs in the market in order to receive that long-term benefit that we're going to get off the stock market returns, because we do believe that over time the stock market goes up and to the right. If you look at a chart, it goes up and to the right. The problem is when you zoom in on it and all of a sudden now it's like, ooh, now it's a little bumpy, Spike. We don't know. And we don't know when those bumps are going to come, which is part of the reason why
it can be as small as somebody announces, Jerome Powell announces we're going to take interest rates down 0.25%. The market drops several hundred points. That might be the day that your withdrawal is coming out from that account.
Yeah.
And it's doubling down on that loss. So we need our income money, the money we're going to use right now. But I think that's part of the issue, is folks will look at their entire life savings and it needs to be in this one place. But you actually talk about compartmentalizing it. Before we leave here today, maybe we could talk about the assignment of jobs of all of those different savings we have.
Yeah, and I think that's one of the things that after people go through our process and they come on board as a client, what they tell us is that why? Why did you come on board as a client? What did we do differently than other advisors? And I will say this, we're not different than everyone out there. We're just different than most. And we're different than most because we provide this holistic solution to you. It is available to everyone. And we work with you to create that income plan. Again, if we carve out an asset that's dedicated for income, that asset then becomes leverage to use for income for the rest of their lives. And then if we dedicate an asset for growth, we can actually take more risk, which means we should receive a higher return in order to do so. But if we commingle these and we aren't really sure what they're for, we can't use them to their utmost potential. And that's what we really try to do, is get the most potential out of your portfolio.
So give us a call, and we'd love to sit down with you soon. I'll kick it back to Spike because we're running out of time.
Yeah, we're running out of time here. Thank you so much for watching. When you come in and get started on your own retirement design, we're not going to be talking about the alpha and the beta and the standard deviation. It's what do we need your savings to do for you? What Billy likes to do is work with the tools that you already have, the savings that you already have, and the design that you've already thought of in the back of your head. And we'll put that down on paper for you and make sure that you can have the retirement that you've always wanted for you, your spouse, and your family. Anything that's on your mind with a dollar sign, come on in. We'll talk to you about it. Put that together in your plan. Thank you so much for watching. Before you go anywhere, before you change the channel, call that phone number down at the bottom of the screen. You can get your own retirement design, no cost. Thanks for watching. We'll be back next week.